Hello guys, welcome back to another lovely trading video. In this one we're going to be showing you how to use the standard deviation channel strategy with a previous example and an example that hasn't yet occurred, but one we can kind of show you that will most likely happen within the next week or so. The reason we're doing this is so you get one in hindsight view and one obviously you can see now and see that it does actually most likely play out as we expect it to. So to get straight into it, all you really need for this strategy, the main thing that we will use is standard deviation channels. So you do need to be think or swim. Some others brokers do now kind of provide it, like Webull, but they're just not as good. So if you can open a US think or swim account, so that's TD Ameritrade, you can also open this from places like England now, but you will be delayed data by 15 minutes. So as long as you're not day trading, I mean, it works well enough. But yeah, think or swim, all you need to do is to add standard dev channel. Add this about 6 or 9 times, and then all you need is 0.51, 1.52, 2.53, 3.54, and those are really the only ones we're going to use. Again, you can go in and change the colors. For example, you see this is a first deviation, and I have this set as gold, so you can go in and change the colors if you want it to match mine. But this has been done in a previous video. If you just go to really my most viewed video on the channel, it'll show you how to set all this up so we don't make this video super long. And then when you have this all set up, this is really all we're going to be trading off. All we use is this kind of whitish line here. This is called a statistical mean. This will always be used as our final profit target and in the area where we look for the stock to reverse to. We then have the golden line, which, well, in my case, it's golden line. This is the first deviation. This will always be kind of our first buy zone or first short zone, but depending on what side we're looking at. Second deviation is again, and third is going to be our final one that we kind of look to buy at, and will usually be the best and most probable one to work. So then when you have all of that, we do tend to use RSI as well. So if you want to add that on, that can help. Just finding if the setup's even more better than expected, and really that's about all we use. I mean, you can incorporate things like volume if you're trying to make sure there's a bit more confirmation into the trades, but it's not something I personally do as of right now. So when you have this all set up, all we're going to be doing then is looking for stocks at least, if we're looking to buy them, we want them below the first deviation, so in this case the golden deviation. If we're looking to short, again, we want them above the first deviation, but obviously to the upside. So we're going to go through two examples. One's a short and one's a long, so you kind of understand how they work. The short bias trade will be the one that's already happened, or a hindsight trade, but we did go through that on both the channel and the Discord, so if you're not watching those, and you could have seen them before it did actually happen. And the long bias trade will be on this chart here, which is Starbucks. But to start off, we'll go through then the hindsight one, and I'll show you how this one worked. So this is Micron, ticker MU. We did start talking about this, I think it was around the 25th, or around Christmas time. I think it was around the 20th, 30th of December, where we started talking about this stock. The reason we started talking about it was because you'll see when it came into this $26 area, we were actually around this green third deviation. But either way, even if it was our second deviation like it is now, that's perfectly fine, because it's still how we would be looking to trade it. That's one thing to consider when trading standard deviations. When back testing it, you have to go in the on-demand feature and go back in time, because each day these deviations move. So you'll see, for example, now, if you're checking, we're filming this, you can see the 20th of January at around 10 p.m. So markets have closed. You will see our first deviation is at $89.92, and our first deviation on the daily is at $85.92. So if you look at this when markets open tomorrow, these numbers will be slightly different. Not massively, but they will be different. So when back testing, again, you have to go actually and rewind time, not just go back and say, okay, this is where the first deviation was at this time, because again, it's not actually where they were in real time. For example, I'll show you what I mean. So this trade, you can see, was around the 29th of December. So if we go on demand, which is back in time, we can then go to that time. So December 29th, 2021, and I'll show you what I mean by this is where the third deviation is. So you'll see the third deviation is around $90. So again, oh, we're actually on November, that's probably why. Let's go to December, and again you'll see what I mean by this. So you'll see third deviation at this time was actually around $25 and $26.40. So what we'll do is we'll place these targets because this is when we would have entered the trade. And so yeah, this is a perfect setup of the strategy. This is the best you can get, and by that I mean third deviation. Again, when you're at the third deviation, so in this case our green one, that's always going to give you the best probability of working. And why is that? So you've probably learned about standard deviation before, but if you haven't, a quick rundown is that you'll have 68% of the data within the first deviation. So between these gold deviations should be around 68% of the time the stock should be trading within those bounds. Then you have the second deviation, in our case of blue deviations, that's where 95% of all data or all the stock trading should be happening. And then you have the third deviation, in this case the green deviation, where 99.7% of all data or all stock trading should be inside of. So if we know that, we know, okay, it should never really be outside of the green data. So by that we know, okay, if for example Micron is coming up to that third deviation, we know, okay, this is most likely where the stock's going to finish. This is most likely going to be the top of its move, and then we would expect it to sell off from then on. So knowing that, that is why firstly we are now short bias. Then what makes this a perfect setup? So this, again, we would trade this either way. This is considered a good setup, but what makes it a perfect setup, and not something you can always wait for because it's not always going to happen. A lot of the time it will touch that third deviation and sell off instantly, but in other cases it may consolidate, or if you're lucky enough, it may have taken a while to kind of get to that level, as kind of in Micron's case, you can kind of see it had a good pullback before. And what this will do is usually allow us to create a divergence. So if we're looking at either the daily chart or the 4 hour, you can see a divergence has been created, and this is what will make it a perfect setup, because what this shows us is not only is it very overbought, but the momentum going up is, well, to hit higher highs is actually getting weaker. So this just gives us added confirmation kind of that most likely this stock is going to reverse. So that's everything we know, and this is when we started to getting Micron short. Again, if you're in the Discord, I posted this multiple times and showed you that I was in the position. So now if we go into real time, this is where we started being short, and you can see standard deviations, this is where it was telling us around $95, $96, it was telling us to be short. And you can see it did take a while, it did consolidate in this level, but it kept bouncing on this level before finally getting its push down and confirmation to the downside. And you can see this is what we consider a perfect sell-off. Third deviation, again, doesn't always have to be third, it can be the first, it can be the second, but third is, if we're looking at perfect setup, we want it at the third deviation. And then a divergence, again, not needed to enter the trade, but is usually a good thing to, well, is a nice thing to see, and what we would then consider a perfect sell-off, or a perfect trade, sorry. And then you'll be able to see Micron from here sold off. So if we're looking at this kind of thing, we're looking to get an average cost between the two deviations. So around this, we would be looking at a $96 average cost. And you can see to where it is right now, that's 12% gain as of now. Obviously, our final target is going to be 82.50, which gives it around a 14% upside. Now, I showed you how we're going to enter the trade, why we enter it, and what can make it an even higher probability. That would be the RSI. Now, how do we get profit targets? Now, our final target is always going to be this statistical mean, and you'll have two statistical means because you'll be using a 4 hour and a daily chart, and you can see we have one at 82.40 and one at 78.15. Now, for locking in profits, we only look at the closest statistical mean, and in this case it's 82.40. And the reason we only look at the closest one is statistical mean. Again, whether you're looking at trading or not, means are used a lot, and you always expect kind of whatever it is, price or your data to return to that mean at some point. So as we're waiting for price to kind of return to that mean, that's where we look to lock in profits, because once it's returned to that mean, you're then unsure whether it's going to go higher or lower. It's a bit more of a gamble. So statistical mean is where we look to lock in all our profits or be out of the trade usually completely by then. So at 82.50 we have statistical mean, that is our final target, and you can track this looking the next few days. Be unlikely if it took a week, but next few days you'll see that that is kind of our final target. 82.50, we should expect price to reverse to this level. Now, it's not the only level we're going to use, however. So again, we started getting short at 96.95. We will then have the levels on the first deviation. You can see at around $90 and $86. These levels will also be used. You may not want to lock in money here, but at least levels where you most likely want to move your stop to break even. But again, you can lock in money at these levels because these are areas where if it's going to continue up, for example, these are the levels it will most likely reverse to before continuing up. So again, we want to use these levels to at least move our stop, but sometimes lock in profits as well. And then yeah, when we come into that statistical mean, that's where we would look to get out of the trade completely. And again, you can use these in different ways. If you're day trading, obviously you're not going to be able to get that whole move from say $96 to 82. You'll have to do smaller trades, but this is more of a swing bias strategy. So something we're looking at for a few days to maybe a few weeks. We don't tend to be in any trade longer than a month with this strategy because we tend to catch reversal points with it. But yeah, I mean, that's quite simply how this strategy works. We'll now go over Starbucks stock because, again, this is one that hasn't yet happened, but we would expect to happen around now, really, to be honest. And you'll see the same thing. You see Starbucks stock, you see it's now at that third deviation. And again, we said 99.7% of data should be within these green deviations. So we knowing that, we know, okay, most likely from here then Starbucks stock is most likely gonna go up. So we can see around $98 and $99 is where the third deviation is, and this is where we're going to start looking to go long on Starbucks. You can see it has actually now sold off a bit past this level. That's not something you're never going to see. You don't see it all the time, but when it does, it just means it just needs that bit longer to reverse. But 9 times out of 10 we still expect that reversal to happen. So seeing this, the only thing we're not seeing set up, which you did on Micron and makes it a perfect trade, is a divergence. You'll be able to see on Starbucks on the 4 hour you're kind of getting this divergence, but on the daily there is no divergence at all. So this does mean it's a bit less probable to happen than Micron, but we're still at that third deviation, so we expect it to happen either way. And you can see, I guess, on the 4 hour at least, we are still looking at a divergence if you're looking at the sell-off all the way back here. I tend to only use the two most recent times it comes into the oversold or overbought area, but this is still considered a divergence either way. So at least we're seeing it on the 4 hour, we're not yet seeing one on the daily, and that can be one thing. Again, strategies you always meant to come in, improve them, make them more something you like for yourself, and that could be something you may like the look of. You wait for their divergence to show before entering a trade. That can work. Sometimes you may miss trades because of that, but it will make your trades higher probability. But either way, Starbucks, again, this is one that we're going to give now, and we expect to see in a week, 2 weeks, or kind of at the latest a month down the line, this trade to have worked, and price bounce from these lows. And where do we start to, or where do we want to see price go to? Now, if you're looking at kind of day or very short-term swings, 102 and 104 are going to be your targets. Reason for that is that there's a next deviation. So if you're looking for a very short-term trade, that's where we'd be looking to lock in profits. And again, you can use these even if you're looking for me, where you look for a reversal to statistical mean. You can still use these levels as maybe a time to move your stop to break even, or just move your stop up at least a little bit. And again, you can use all these targets. 106, 109 are all targets you can use along the way. But what's going to be our key final profit target? And in this case, you can see it's right around $111. Again, obviously price will move a bit by then, and as you can see, our 4 hour deviations are heading down, so we're going to be looking at our target a bit lower. So by the time Starbucks reaches that level, it could be around 110, 109. So really, that's a kind of move we're looking at on Starbucks. Our average cost as of right now is around 98.50. 150, and we have a final target of around 110, 111. So right now this is providing around a 12% upside on this trade. And obviously statistical mean on the other chart, or if you're looking at the daily, is around 114. But again, we only look to trade to that first statistical mean. So that's why 111 is our final target. Now, how can you trade these? Do you want to use shares, options, or kind of whatever? Again, that's up to you. How you trade, you'll trade in different ways. I kind of trade these in two main ways, or three main ways actually. One is using just shares, or if you're from the UK or countries where CFDs are not illegal, then you can use CFDs, but works the same way, and that's literally just buying the physical share or the CFD and holding it like you would a stock. Then what are the other ways you can trade it? Options are the other ways I trade it, and that's two ways. That is, firstly, you can just buy an option. And I don't actually trade Thinkorswim, but I think I am holding an option actually of yeah, I am. So you'll be able to see Starbucks. All I've done with this is literally just buy a singular call. I'd say again, I don't use actually Thinkorswim for trades. It's just for charting. I think I have a bit of money in the account, so I just took the trade on it. But you'll be able to see all it is literally just buying a call. Quite a simple way to trade in as well. If you don't have, if you've only got maybe level 1 or level 2 options unlocked, you can't really do much else apart from literally buy options. So if that is it, you can buy a call. And again, if you, for my example where we're looking short, you buy a put. And again, you don't want to be buying something that expires too quickly, because the problem with that is you've got to give it time to still reverse, and that is kind of the benefit of using options. Is, let's say you know your max risk is $300. What you could do is, I think this was around $175, so you know you could buy 2 contracts, you can let them expire, you don't have to manage that trade really at all. You can say either it gets to the 4th of March, it expires worthless, okay, that trade was a loser, or you get to the 4th of March, it was a winner, and then you can see by how much buy. I mean, these kind of trades, if they kind of bounce within the first week or two, you'll make usually really good returns. If you don't see it actually bounce until March time, or late Feb, you may see that, I mean, you'll obviously still make money, but it may not be a crazy amount. And you'll see, why did I pick them 104 as our call number? Firstly, just because it was cheap. I don't have much money in this account, so I can't use a massive amount. So I had to kind of compromise a bit on that. But if you see, if we go over to how much the calls are, firstly you look at what your main profit target is. And when we looked at ours, you know, okay, it's 110, 111. So we know, okay, we want it to be around that level, just because then we can buy a lot more options for the price, and we do expect it to come to that level. So if we're buying calls that are out of money, they finally come to that, they will increase a lot more than ones that are already in the money. And if you don't really know what that is, then you probably shouldn't be trading options. Go through some options videos, learn what in the money, at the money, out the money all means. But either way, 104, the reason we chose that is, firstly, it's the only one we could really afford on the account. We couldn't really go any closer. So we're like, 104 is kind of a good area. We know our key target is 110. So we know, okay, looking at 104, let's say it doesn't get there until the 4th of Feb. We know, okay, I think we paid $175 per option. So we know, okay, as long as Starbucks is above $105.75, at the time of expiry, we're going to make money on this trade, and as we expect that to be something that will happen, it makes the trade relatively low risk. And that's why I don't mind buying calls, is because, again, if you know what your max risk is you don't really have to manage it. Some people will sell their calls when they become quite cheap. With this, I don't really mind just letting them run. But again, if that was maybe like you've only got like a $1,000 account, and then this strategy you can't really do, because obviously you'll be risking too much a trade, and it's not like you can say go on all strikes, get very far out the money. For example, $140 calls at $22 just because well, it's just very kind of risky doing that anyway. So you're probably best off taking shares or CFDs, whatever you can do on if you have a very small account. Now, what's the final way you can trade these, or at least I can kind of think on how to trade these, or how I personally do trade these, is then using cash secure puts, or cash secure puts or kind of iron condors. So for example, Starbucks, obviously right now it's at around $96. Again, we're expecting it to get to around 110. So what we can do is, if you're doing cash secure puts, you can just sell where current price. So say $95, you could sell a covered put, or a cash secure put, sorry, at around $400. What does this mean? This means you get paid $400 no matter what. But it does mean if Starbucks at the 4th of March is below $95, you have to buy 100 shares for each contract you sell. So again, that's why you need a bit more money on the account to do this kind of strategy, because obviously you need to have at least 10 grand to buy those shares. But either way, you'll pay that $400 to buy it, and this is why it's great to do on blue chip, and we only really use blue chip or large cap stocks, because either way you're kind of happy to buy the stocks, and if it's by third deviation, it's a very good discount. So that's one strategy I don't mind using. Now, what's kind of the final way you can use it, and it's kind of using the same way as a cash secure put or a covered call, those kind of things. But instead of just, if you got a smaller account, you can, for example, sell a 95 put, and then you could buy, say, a $90 put. Now, what this means is your max risk is essentially $500 minus a premium difference, so around $300, because you'll be buying or selling for $400, so you instantly receive $400. You will then have to pay around $200 for that $90 put. So there you've made around $200. But now you have a max risk of a $500 difference, which means your max risk is around $300. So that's one way you can trade it. Your max risk then is $300 to make $200. So obviously that's less than a 1-to-1, and that's why if you're doing this, I wouldn't really recommend doing at the first deviations or second deviations, and only at third deviations. And the reason for that is we still expect price no matter what to kind of bounce from this level. However, if you're at the second or third, yes, we will play the bounces, but it's a bit more probable that they'll come down. So if you're not getting a 1-to-1, we only want premium and really good setups. So really we want A quality setups if we're taking less than a 1-to-1 risk to reward. So again, if you're doing that final strategy where you're buying it or selling a put and then buying a cheaper one, that's a way to manage risk, and you don't need all the money in the world, or you don't need a lot of money to take those trades. That's one way you can do it. I think you do need a high options level. I think you need level 3 or 4 for that. But either way, that's one way you can trade it while limiting downside. But again, obviously, as you're limiting downside, you're kind of limiting your upside as well. But again, it's just one of the trade-offs you have to do if you trade that kind of way. So again, I hope this video then kind of gives you some insight into the strategy, how you can trade it. And again, stop losses, it's something I don't really like to cover because it's very unique to the person. Firstly, on risk tolerances, size, and again, how you're trading. Obviously, if you're buying options, you may decide to cut them when they're down 50%, or you may just look to hold them until expiry. So that's one way. If you're trading stocks and shares kind of way, really, it's more, you're going to have to find your own personal preference. One way you could say is, if you're looking at your upside, for example, I think our upside, if we go from 98.50, upside is around 12.5%. Again, you can then work out what you want your risk to reward be. Do you want it to be a 1-to-1, a 1-to-2, whatever, and that's how you can work out your stop. For example, if you want it as a 2-to-1, you can have your stop around $92. If you want to do it as a 1-to-1, you can have your stop all the way down at $86, and so on. So you just have to work out where you want your stops. A lot of the times, if you're buying at third deviations, it's usually not going to be yearly support, so you can't really use those kind of levels. So again, you kind of just have to find your own preference in that. You could also use psychological levels. What do I mean by that? It means really hold dollars, but you tend to look at maybe 90, or for example, $100, $95, $90, and so on. But again, that's very preference driven, and that's the only problem with stops is everyone has their own way of finding them. But either way, I hope this gives you some good insight into how to trade standard deviations. And I hope it helps going through a prefix example and now giving you one that should play out within the next few weeks. So I hope you enjoyed the video, hope to see you in the next one, and that's it. Peace.
I go dumb for that money, dumb for that money. Profit on top of profit, Donald Trump kind of money, okay.